This is it. This is as good as it gets. You want to know what's worse than a ringing phone? Silence. Now we're going to get this stock to close above 480. If you can't handle it, show yourself out the door.
Before becoming a trainer, I spent nearly 10 years working in investment banking, and I'm going to draw on some of my experiences to review the latest season of industry. Let's start with a brief recap, just in case you haven't watched previous seasons of industry. The first season started off with 5 young graduates completing a grueling internship to try and secure a job at fictional investment bank Pierpoint Co. The second season then covered the emerging careers of those analysts, and for those that remained at Pierpoint, their return to the office after COVID lockdowns. By season 3, just 2 of the original analysts are still working at Pierpoint, whilst a third is now working at an ethical hedge fund, Future Dawn. As with previous seasons, industry is really well researched and provides us with lots of opportunity to learn more about the workings of the investment banking industry. So let's have a look at some of my favourite scenes from Industry Season 3 and see what we can learn.
Pierpoint's been overexposed in sales and trading. This has been ameliorated by our commitment to the green shift.
And on the day of his partnership, it's important we credit Eric's work in the trenches. Lumi is just the first in a pipeline of environmental, social, and governance-oriented deals we have, a suite of in-demand, ethical, and social impact IPOs that we've won over our competitors.
Look, ESG is a great marketing tool, and I'm sure it's helped Pierpoint's stock price to be included in all the ethical investment baskets, but shouldn't we be wary of increasingly gearing our balance sheet toward a fad?
Excuse me?
Woke investing, greenwashing. So our business model isn't a rigorous balance sheet examination. We just look at the org chart and then Chatham House rules apply. Pray that the CEO is a black lesbian with one leg. Then, without even meeting her, sign they, them, a blank check. Have I got that right?
I'm sorry. Chatham House rules means carte blanche for bigotry?
Maybe you can leave your cynicism at the door while this trade still has legs.
Pierpoint Asset Management, our private equity division, is heavily invested in these companies. Lumi, Europa Gas, out of Frankfurt.
Momentum is everything. With the successful launch tomorrow of Lumi, the first domino falls and will signal to the market that the other European live IPOs we have in the pipeline will hit.
During this scene, in the very first episode, we're introduced to one of the main themes of this season, the impact of ESG investing. We hear cynicism from one of the board members that focusing on ESG is just a marketing tool, rather than having any real benefits to the bank or investors. So let's explore this in more detail. Environmental, social, and governance investing means incorporating risks related to things like climate change, customer welfare, labour practices, and business ethics into your investment decisions. Although different strategies are used by investors, the underlying principle is that by minimising your exposure to these risks, you can enhance your investment returns over the longer term. This approach to investing has grown significantly in popularity over the last decade, to the extent that over a fifth of managed assets now includes some ESG analysis in their investment strategy. The issue is that the world of finance is now wise to the fact that ESG sells. There are growing concerns that ESG becomes just a tick box exercise, so that investments can be labelled as green investments, even if they have significant unmanaged ESG risks, a practice referred to as greenwashing. So is ESG just a fad? Well, for many investors, the better you understand and quantify risk, the better you can manage it and generate higher returns. That's not a new concept and applies just as much to ESG risks as other risks. What is new is that some of these risks no longer sit on the distant horizon. For example, many countries are already changing how they generate and use energy, what we refer to as the energy transition, and that's in response to both government policy and technological advances. There will inevitably be winners and losers in this transition, and it isn't sufficient to assume that a company with ESG credentials will be a winner. Successful investment decisions are grounded in proper due diligence.
We've got some last-minute concerns about your valuation. Based on the very sneakily timed earnings report with its surprising net debt figure, the debt profile of the company has seemingly shrunk overnight, just as you're about to go public.
So?
In your cash and cash equivalents,
You've added in receivables, which you know won't get settled.
you've calculated your indebtedness as a net debt to EBITDA ratio, and it looks like you've just...
Massage the EBITDA to make that ratio decrease.
What are you accusing me of?
This earnings report, your first as a public company, will legally have to be published on your website for anyone to see, and you're putting lipstick on the pig at the last minute.
Which got me thinking what else you're keeping from people. So I had my analysts up all night.
Modeling what would happen if, say, given your debt profile, natural gas prices spike. My conclusion is that you'd be sailing into a storm on a shit boat. Therefore, we disagree with Pierpoint's price of 4.30 pence a share.
Should be close to £4. We have doubts over the
The
projected.
closing price of 4.80.
James, let's just drill down to the crux here, shall we? You know the fundamentals are strong.
Sir Henry. Sorry, I know that doesn't make you sound very modern. I'm going to be reasonable. I'm going to offer you back half my equity at 4.30 a share.
As per the Pierpoint valuation.
Hi, James. It's Yasmin from Pierpoint on the line. Look, Lumi is at the forefront of the democratization of the energy sector.
Yeah, I keep hearing that, and I still have no idea what it means.
In this scene, an investor flags their valuation concerns to the CEO of Lumi, a green energy company which is about to go public. So what does it mean to go public, and what are the investors' concerns? Well, companies go public through an IPO, that's an initial public offering, so that their shares can be publicly traded and to raise extra cash for the company. So how do the bankers work out what price to offer shares at to investors during an IPO? Well, during the IPO, the Equity Capital Market, or ECM, bankers advise the management team on what the company itself is worth, and we refer to this as the enterprise value. The bankers then deduct the amount of debt that the company has from the enterprise value, and what's left is the equity value. That's the value for the prospective owners of the company. Now, this concept is similar to how you would estimate the value of your equity when selling a house. You'd seek an expert opinion from a real estate agent on the value of your property, and once you deduct the value of your outstanding mortgage, what's left is your equity value. The investment bankers then divide the equity value by the number of shares after the IPO to give the price at which the shares are expected to trade, and that's the closing price of 480 pence in this scene. However, this isn't the price that the investors pay during the IPO. The shares are offered to investors at a small discount to this price, typically a 10% discount, to reward investors for participating in the IPO. Now, Pierpoint has recommended an IPO price of 430, but the investor believes that this should be closer to 400 because the company has artificially reduced their debt figure, which inflates the equity valuation and therefore the IPO price. Now, this scene really highlights one of the key tensions in an IPO. The company wants to maximise its valuation and therefore the cash raised during the IPO, but investors want to pay as low a price as possible, as this increases the returns that they generate when they eventually sell the shares in the future. The bank sits between the company and the investors and needs to ensure that both are satisfied. And they can only do this by providing a valuation that is as close as possible to the final trading price.
Hi, I'm so sorry. It's been a crazy morning.
Did you guys oversell the fundamental story? Do people know something that I don't? My reputation in front of my board is on the line here. Did Pierpoint overvalue Lumi?
Anna, you have to trust me, okay? This is just panic. You don't want to be trigger happy and look daft when the market turns in our favor.
It better turn.
I'm bid only, Lumi. Bid only. It's just finding a level. If anyone asks for an offer, they'll end up like Mussolini and his missus.
Is this price live? We started at 430. We're already trading down at 400. What percentage decrease is that? Do it in your head, fuckface. Did you read at Oxford?
Geography.
Why?
Harry, good to see you, mate. Yeah. Have a good day.
We'll try not to monitor it like a day trader then, sir.
Are you kidding? Every tick down is potentially tens of millions.
More if your net worth.
Tobias, thanks for supporting. Thank you for being here. Thank you.
Off the valuation of the company to its public perception and therefore its health and consequently its ability to do good. How did these hacks get my fucking number?
In this scene, we see concerns over how Lumi's shares are trading on the day the IPO launches. Unfortunately, things are not going well, and the shares are trading at 400, which is below the IPO price of 430. An IPO which trades below the offer price on launch day is often referred to as a busted IPO, as it means that investors who participated in the IPO are sitting on a loss. This isn't just bad news for the investors though, it's also bad news for the company, as the share price will struggle to recover in the absence of any significant positive news flow. It's also bad news for the investment bank, as it might deter other companies from using them as their advisors on their own IPOs.
So what's the street saying in terms of brokers' recommendations on Lumi?
Likely the syndicate banks will publish a mixture of buy and hold. Our analyst Frank's the tastemaker in the energy sector, though, so people are waiting on his view.
When's he publishing?
I heard whispers the next 48 hours, but I imagine it'll be after. Our research team know to manage the rollout of positive catalysts on the stock. His note would be more effective with breathing room after the panel.
And you're confident it'll be a positive? His tone on the call was a bit hostile.
We did the IPO. He knows who butters his bread. You got any scotch?
We have McKellen 18.
In this scene, the bankers are discussing the broker recommendations on Lumi, and Eric says that the syndicate banks will likely publish a mixture of buy and hold. So what does this mean? The syndicate banks are those that have been involved in the IPO. These banks also have research teams which publish reports on publicly traded companies to help investors decide which shares to buy or sell for their portfolios. Now, shortly after a company becomes public, the research teams publish their views on the company for the first time, and that's referred to as an initiation report. The report gives a recommendation on whether investors should buy, sell, or hold the shares. A buy means that investors should buy the shares because the shares will outperform the market. A hold means that investors should not change their current position because the shares will perform in line with the rest of the market. And a sell, well, that means that investors should sell the shares because they'll underperform the market. Some research analysts are particularly influential, and the Pierpoint analyst is referred to here as a tastemaker, meaning that his research can potentially move the market. But why? Well, because investors trust the analyst's views, and a buy recommendation results in more investors buying the company's shares, which in turn leads to a rise in the share price. It seems that some investors are waiting on the Pierpoint analyst's report before deciding whether to buy Lumi's shares. One interesting point is when Eric says that the Pierpoint research note will likely be positive because he knows who butters his bread. This highlights a further tension within investment banks. Research teams are required to be completely independent of the rest of the bank. This means that the bankers cannot put pressure on research analysts to give a particular rating, and research analyst bonuses cannot be linked to IPO fees. However, Eric's view is that regardless of this independence, the analyst knows a sell rating would reflect badly on Pierpoint, as it suggests that the IPO valuation was wrong. This in turn could impact on the IPO pipeline. Eric therefore believes that the analyst will give at least a hold rating for Lumi.
You have a king for slaughter and sacred cows. You know we can't short these. They're not publicly traded companies.
We don't want to short these names. We want to short Pierpoint.
In as much size as you will give us. That's why we're bringing this trade to their biggest competitor.
You mean their cast-offs?
Pierpoint took a gamble on bringing 60 supposedly promising ESG-focused companies to the market. They took a significant position as the anchor at a bad level, and to support that bet, took on a lot of debt. That debt is reaching maturity, and it cannot be refinanced. This is growing knowledge across the street.
Liquidity elsewhere in the bank?
Zip. Pierpoint has no way of paying its debtors back.
How the fuck did they allow themselves to get into this hole on something as banal as ESG?
They wanted to be first movers. Pierpoint's asset management division has become a proxy prop desk and has been given undue influence over the balance sheet. I mean, it is little more than a shell company for shit.
It's no wonder they brought in Wolsey to fix it.
In this scene, a hedge fund is seeking to take a short position in Pierpoint. This means that the hedge fund is essentially betting on the share price of Pierpoint falling. But how does this actually work? Well, the hedge fund wants to borrow Pierpoint shares from the prime brokerage arm of a competitor bank. The hedge fund then sells these borrowed shares in the market. Let's say that it borrows the shares and sells them while the shares are trading at $100 per share. Well, if the share price falls to $90 during the next few trading days, the hedge fund could buy back the shares at $90 and make $10 profit per share. Now, although the hedge fund now owns Pierpoint shares, these are still effectively borrowed from the prime broker. So the hedge fund returns the shares to the prime broker along with a small fee for the lending arrangement. This allows the hedge fund to make trading profits from a falling share price and is referred to as taking a short position.
Hey guys, anyone in New York got any color on the reversal in Pierpoint's share price?
Carrying away some sizable shorts building? Yeah, something to keep an eye on.
Eric then sees that Pierpoint's share price is falling on his Bloomberg terminal. He asks for colour from a colleague who notes that there are some sizable short positions building. Investors are required to publicly disclose short positions, and the total short position across the market is referred to as short interest, and it's often expressed as a percentage of the number of shares in issue. This is a keenly watched metric in the markets, as a high level of short interest means that there is a high level of conviction amongst investors that the share price will fall.
You have the Assistant Secretary.
Graham Steele speaking.
This is Tom Wolsey in dreary London. I'm told Wilhelmina brought you up to speed last night.
Yeah, listen, I've reviewed your situation. It looks like you positioned yourself as lender, buyer, and seller, like JP Morgan with WeWork.
Yeah, one-stop shop.
And you didn't think this was an appropriately high risk?
And incestuous, yeah. For the record, I think it was. Well, we liked the risk-reward. In hindsight, not so much. We're looking for an emergency cash injection of around $15 billion in short order to plug the hole and give us a chance to restructure. Yeah, our current share price is $45. It's now 8 p.m. UK Thursday night. We need to resolve this before the US markets open on Friday, 2:30 p.m. UK.
Okay. I don't have the reach or, frankly, the influence to advise here.
You're Assistant Secretary of the Treasury for Financial Institutions, Graham. If you don't have the authority to do your job, I want to speak to someone who can.
I'm going to pull the Treasury Secretary out of her 3 p.m., okay?
In this scene, the board of Pierpoint are seeking a cash injection of $15 billion from the US government to plug a hole. So why do they need to do this, and why must it happen before the US markets open the next day? Well, all companies, including banks, need cash to continue trading. We refer to this as needing sufficient liquidity. A company is not viable if it doesn't have liquidity, as it cannot meet its debts as they fall due, even if the company is otherwise profitable. A lack of liquidity is the main reason that companies file for bankruptcy. Now, we know from the previous clip that Pierpoint has some loans, referred to as senior subordinated debt, which is now due to be repaid. This debt was used to finance purchases by their asset management arm in shares of the ESG companies that they helped to IPO, and that's what is meant by acting as lender, buyer, and seller. Unfortunately, the ESG shares no longer have much value, so they can't be sold to help repay the debt. And the market is becoming aware of this, so Pierpoint's share price is falling. So why does the funding need to happen before the markets open the next day? Well, some of this is about ensuring that Pierpoint can meet the debt repayments which are now due. But the urgency also reflects the fact that banking is a business which relies on trust. If the markets and banking customers lose confidence in the bank, then the markets will stop lending to the bank and customers will withdraw their deposits. So the bank will then fail, even if it could initially meet its debt repayments. This is very similar to what happened to some banks during the global financial crisis. So if the share price continues to fall, this will undermine confidence in the bank and bankruptcy becomes a self-fulfilling prophecy. A boost of cash from the US government would help to shore up Pierpoint's finances and restore confidence in the bank. Unfortunately for Pierpoint, the US government is not willing to help out with this funding. So let's see what happens next.
Our proposal is that the Mitsubishi Financial Group invest $9 billion in equity in Pierpoint for a 19% interest in the company on a fully diluted basis. How did that get there? As I was saying, our friends at Mitsubishi are the best partners we could have. They have enough dry powder to buy up our distressed debt and to support the other assets on our books. And they want us to be us. They have reverence for our name.
We want to help build Pierpoint back to what it could be in its 150th year.
We expect a very healthy ROI for you on a decade-long horizon.
In this scene, we see the board of Pierpoint meeting with potential investors Mitsubishi Financial Group, who are considering investing $9 billion in Pierpoint in exchange for a 19% stake. Pierpoint CEO highlights that Mitsubishi has enough dry powder for their investment. This refers to their cash and liquid assets available for investment. The CEO also highlights that the investment would provide a healthy ROI over the next decade. Now, ROI is return on investment, and it's calculated by dividing the investment gain by the original investment, expressed as a percentage. So if Mitsubishi invests $9 billion today and then sell their investment 10 years later for $18 billion, well, that's an investment gain of $9 billion, which is equal to my original investment. So that's a 100% ROI. That sounds great, doesn't it? Well, unfortunately, this highlights one of the limitations of ROI. It doesn't consider how long it takes to generate that return. As a result, analysts tend to prefer internal rate of return, or IRR, for investment appraisal. IRR tells you the annual rate of return for each year. If I invest $9 billion today and sell my investment 10 years later for $18 billion, well, that's equivalent to an annual rate of return, or IRR, of just 7%, which sounds much less impressive, and in fact is less than you would generate most years investing in the US stock market. So IRR can be much more useful for comparing investment opportunities. However, the next part of this scene is the really meaty part.
But of course, apologies for the small inaccuracy on page 12.
What inaccuracy?
I'm assuming this reference is linked incorrectly. It looks like you are linking to enterprise value instead of equity value. It's causing a 15% decrease in the true PE multiple, which should otherwise be 7.6 times. Well, below peers.
I'm so sorry we missed this. That's like a 2 to 3% uplift in IRR.
After 10 years of what we know will be a mutually beneficial relationship.
How could we have missed that? It's sloppy. Eric?
No, it's fine. Leave it. It's late. It happens. It's just a book.
That's a huge decrease in the valuation. How didn't I spot it?
Bill, you did spot it.
When?
We ran through it about an hour ago. I raised it again in the bathroom just now. You said wasn't a deal breaker in the room that they know the numbers already, which they do. We can move on.
That didn't happen.
Eric and Mitsubishi flag an error in the PE multiple in the presentation. Now, if you view the footage in slow motion, the presentation shows a PE multiple of 8.9 times, but Mitsubishi says the PE multiple should be 7.6 times. So Pierpoint's figure is overstated by 15%. Let's dissect this a bit. A PE multiple is a really useful way of comparing a company's valuation with that of other companies. We can't just use share price to compare values because it really just depends on the number of shares each bank has. So instead, we divide the share price by the earnings per share to give a PE ratio. We can then use the PE ratio to compare the valuation with other banks. A high ratio implies an expensive valuation and a low ratio implies a cheap valuation. Now, this process is very similar to how you might compare the valuation of two apartments of different size. One apartment might be worth $1 million and have a square footage of 1,000 square feet, and a second apartment might be worth $500,000 and have a square footage of 500 square feet. We can't compare the apartment values in absolute terms because we know square footage affects the valuation. So to make them more comparable, we calculate a multiple, price per square foot. And we find that both apartments are valued at $1,000 per square foot, which is a more meaningful comparison. Now, Mitsubishi flags that Pierpoint's correct PE ratio of 6.7 times would be well below the valuation of other banks. A likely reason for this would be that the growth expectations of Pierpoint are much lower than the other banks. One final point to note is that errors in presentations to clients or investors are extremely unprofessional. They can completely undermine confidence in the bank's analysis, which it does after this scene as Mitsubishi walks away from the investment. So if there is one learning point you take from this scene, it's always important to check your numbers before sharing them with a client or an investor.
We know you have a decades-long plan to become entrenched in Western markets, sports, franchises, entertainment venues. But a bank is a more unique proposition in terms of its reach and influence over foreign institutions. Finance isn't a space you can just break into.
You'll be buying both our US and our European banking licenses. Plug and play.
In these scenes, we see Pierpoint finally securing its future by negotiating a takeover by a private equity investor from the Middle East. Eric then briefs the staff about the takeover.
Are you serious? It would be unwise to confirm or deny speculation. Given the sensitivity of our share price. You know, I've stood in this room many times. I've watched a lot of you grow up. I think if I could see myself as a grad now, me, immigrant son, bespectacled, so scared of my own shadow, swallowing down the promises of capitalism and meritocracy. Do I look like a man who was lied to? Today? Our prospective partners believe in the principles that I heard on my very first day here. I cleave them to my heart, like you have. Pierpoint people. This is what we're selling. How well you've come to embody what you've been taught. You are all safe. That's something. You are all safe because you are the asset. Growth and change are inevitable, but this process must be anchored in shared values.
Eric's main message is that the staff are one of the bank's main assets. This is important. Although a bank's balance sheet shows its assets as loans and investments, a bank trades on its reputation, which in turn depends on the quality of its staff. It's the staff who conduct credit risk analysis to help decide which new loans to make. It's the staff who advise clients on deals which generate fees for the bank. And it's the staff within asset management who conduct investment appraisal to help decide which new investments to make. And this is why recruitment, continuous training, and retention of talent is so important in the banking industry. Your staff and talent is what gives you a competitive advantage over other banks. It's a reminder that although working in banking can be very competitive and high pressured, banks also need to look after their staff and nurture their talent and ensure that they are well remunerated. If you enjoyed this, please like and subscribe to our channel so you don't miss out on more reaction videos and career-related content.